You get paid, you pay your bills, and then you hesitate. Checking your bank account feels like bracing for impact. You show up, you work hard, and maybe you even secured a raise this year. But at the end of the month, the balance in your account remains stubbornly fixed. This frustration is reflected in the national data. The Bureau of Labor Statistics tracks exactly what Americans earn and how much those earnings can actually buy at the store. Average hourly earnings climbed by 3.5% over the past year. On paper, American workers are bringing home more money. But when the agency factors in inflation to calculate real earnings, that gain vanishes. Your actual purchasing power grew by a mere 0.2%. The gap between earnings and the cost of existence has fractured. For millions of households, the current math simply does not allow for a surplus. To find out where that money is disappearing, we have to look at the first major drain on your paycheck: macro-level inflation. For years, the blame for these high prices fell on broken supply chains and massive global energy shortages. However, recent data from the Groundwork Collaborative shows a different driver. Corporate profit margins accounted for roughly 53% of inflation during the second and third quarters of last year. The math is stark. While the cost for producers to make goods rose by only 1%, the prices they charged consumers jumped by 3.4%. Take the diaper industry, where two companies control 70% of the market. Even as the cost of raw materials like wood pulp dropped by 25%, shelf prices remained high, allowing corporations to capture the difference as windfall profits. Families are paying 25% more for groceries than they were a few years ago. When corporate profit-taking keeps prices high while input costs fall, any wage increase you receive is instantly absorbed at the checkout counter. While corporate pricing skims your daily income, your housing situation takes massive, unavoidable bites out of what remains. The traditional 28-36 rule suggests spending no more than 28% of your gross income on housing to maintain financial health. But with global home prices rising more than 50% since 2020, this guideline has become a mathematical impossibility for a significant portion of the workforce. This trap is further complicated by where you live, as the United States has an extreme geographic divide in the cost of existence. On the affordable end of the spectrum, states like Oklahoma require an average annual household expenditure of roughly $66,000 to cover basic needs. Contrast that with Hawaii, the most expensive state, where those same annual household costs skyrocket to over $141,000. These fixed regional costs consume a disproportionate share of the American paycheck, leaving the foundational budget broken before any discretionary spending even occurs. After navigating macro inflation and regional housing costs, the remaining fractions of your income face a final, nearly invisible drain. Modern transactions are designed to hide the weight of spending. With the tap of a phone or an auto-renewing software trial, money leaves your account without the psychological friction of physical cash. The average household now carries 12 or more active subscriptions. Between streaming services and app memberships, these small, recurring charges often total more than $200 a month. When these invisible costs push a monthly budget into a deficit, it triggers the reverse compound effect, where wealth isn't just stagnant, it's actively being destroyed by interest. A $50 monthly overage left on a credit card at 20% interest balloons into thousands of dollars of debt and accumulated interest over 5 years. The modern consumer environment is optimized to silently bleed away any income surviving inflation and housing, turning minor indulgences into long-term financial anchors. We are navigating 3 distinct layers of extraction: corporate price hikes, fixed geographic housing costs, and the invisible drip of digital subscriptions. In a landscape optimized for extraction, an empty savings account is the predictable output of the variables we have just tracked. Acknowledging these systemic forces is the first step toward reclaiming agency. While you cannot influence national inflation or local property values, you can focus on the variables still within your reach. Systemic pressures set the floor of your expenses, but micro-habits determine where you stand on that floor. In a high-cost environment, managing the small drains on your account is the only defensive strategy available for immediate use. Reclaiming $200 a month from unused subscriptions and small lifestyle shifts won't fix the housing market, but it stops the cycle of debt. Invested at a 7% return, that same $200 grows to over $100,000 in 20 years. Escaping the squeeze requires understanding exactly how the system is designed to extract your income. Taking back your financial future starts by mastering the smallest, quietest choices you make every day. Follow for simple money truths that actually make sense.